What I'd like to do with this session is to make it as interactive as possible. So, you know, if there's something that I mentioned that's particularly interesting or that you're curious about, just fire the questions at me. And if nobody has been brave before the end of the session, we'll leave 5 or 10 minutes at the end for questions if that appeals more. So, you know, I'm just going to start by giving you a little bit of information about how I ended up doing what I'm doing. So my current role is Head of Investment Strategy at Mellon Capital. So Mellon Capital is one of the investment management boutiques that's owned by Bank of New York Mellon. And the Dreyfus connection is that Dreyfus essentially is our mutual fund arm. So, and we're based here in San Francisco at 50 Fremont, so pretty local. We manage about 350 billion in assets. And the assets that we manage range from indexing through to active asset allocation, total return type strategies. So really my role is on the asset allocation side of the business, which is more global macro, looking at the broader global economy. And it's always funny to think about, you know, looking back, what actually prompted you to get into that part of the business. So for me, it actually dates back to a vacation I was going on with some girlfriends to Italy back in 1992. So this was in September. And we had to change our money from Irish pounds to Italian lira. And we'd been, you know, looking at what we thought we were going to get. And then when we actually went in to change the money, we were getting an awful lot more lira than we expected to get. And basically what had happened was Italy had fallen out of the exchange rate mechanism. So the exchange rate system that was basically linking them all to the German Deutschmark. And so that was really my first exposure to the fact that, well, things can happen in currency markets. And it really started to get me interested in currency, and that's where I started my career. So I started out on the trading floor at Chase Manhattan in London in 1994, which is a very interesting place. I think less than 10% of the employees were women. So it was I
was one of those. It's a great place to learn about the markets.
Well, fantastic experience, and really cemented my interest in currency markets. And still today, they're probably the market that I tend to focus on first, because it's influenced by so many different things, and whether it's politics, economics, geopolitical risk. So I started managing currency on the asset management side and then moved into a broader global macro. But it's certainly been very interesting to see how the industry has evolved over the last 20 years or so. But now turning to markets, it's a very interesting juncture, and there are a lot of risks on the investing horizon. But with risks, you also get opportunities. You know, certainly the first quarter of this year, particularly if you look at January and February, were very, very volatile. And we seem to have entered a period of relative calm. So what I'm going to do is give you a little bit of detail about our background, our outlook on what we're expecting, how we're thinking about different markets, where some of the opportunities might be, spanning across, you know, equities, bonds, currencies, and commodities. And also just a few of the potential risks on the horizon, just things that it's worth being aware of. So I would term our overall view as being cautiously constructive. So what that essentially means is that generally we think that equities do represent an interesting opportunity. So we've got a reasonable allocation to equities in general. But we're cognizant of certain risks. So in terms of how we position our portfolio, I'll talk a little bit about what markets we like, why we like them, and then some of the risks that we're also thinking about. So we invest globally, primarily in developed markets. And when we look at developed markets, what we think looks pretty interesting right now is Japan. So Japanese equities have had, in the first few months of the year, a pretty tough time of it. And essentially what you tend to see is that when the Japanese currency, the yen, strengthens, that the equity market tends to do poorly. And we've been seeing the yen strengthen quite significantly for most of the last 3.5 months. So when we look at Japanese equities, really what we care about are the underlying fundamentals. So what do we think should be driving these markets? And for us, it starts with earnings. So looking at not just the consensus expectations for earnings, but also what we think the underlying earnings are going to be, taking account of the overall quality of those earnings. Now, and what we mean by quality is, depending on the accounting standards that you have in different countries, what one company reports in Japan as $1 of earnings can translate to a different amount of cash than, for example, what a company in Italy reports as $1 of earnings, because the accounting standards are different. And what you want to see for a high quality country is that $1 of earnings essentially translates to $1 of cash, more or less. And we also look at how earnings are being revised. So in other words, how the companies are managing their expectations and how analysts are thinking about how those countries are going to perform. Now, when it comes to Japan, they're one of the few markets where you're actually still seeing an expected earnings growth that's in double digits for 2016. Most developed markets are in single digits. If you look at the US, it's about 1 or 2%. But there are a number of other factors at play within Japan. So there was a very big initiative that the government has put in place. It's called Abenomics. Oh, sorry.
Did you say that Japan is one of the few markets with a double-digit GDP growth, or what type of?
Oh, earnings growth. So when you look at corporate earnings growth, yeah. So with Abenomics, what they're really trying to do is kickstart the Japanese economy. So really since the mid-90s, Japan's economic growth has been pretty poor. They've either had zero inflation to negative inflation for most of the last 20 years. Now, the reason that causes such a big problem is that Japan's government debt is very high. It's about 250% of GDP. So one of the weapons that any government has, if they've got a large stock of outstanding debt, is inflation. So if you have positive inflation, essentially what that means is, if you've borrowed $100, that's not still $100 in 5 years' time. That's probably closer to about $90 in today's money. So inflation helps you to pay down that debt. But in the case of Japan, where they were seeing zero inflation or even negative inflation at times, that was causing them a big problem. So the whole thinking behind Abenomics was essentially, let's get economic growth going, let's increase inflation, and that's going to help us to grow the economy, but also help to pay down some of the debt. So they've done a number of things. They've really weakened the currency, which does help the stock market. They have introduced measures that are really designed to help spur inflation. So they've actually mandated that companies which are doing a lot better because they have a weaker currency increase wages. But another element of it is corporate governance reform. So one of the things that is very interesting when you look at different markets globally is the way in which companies are run. And maximizing shareholder value seems like a very sensible way to run a company. It's what you see with every company in the US. They want to make money for their shareholders. That hasn't been the case in Japan, and that's a much newer phenomenon. So you had a lot of companies that were not just privately held, but even for the public companies, there were a lot of cross shareholdings, and so you weren't seeing the companies being run in the right way. So the focus on corporate governance has really increased. They've developed a new index called the Nikkei 400, where it's not just based on the Nikkei 400. It's not just based on the market capitalization of the company, but 2/3 of the weighting is actually determined by corporate governance measures. So things like having external directors on the board, And so longer term, that's a very big positive. And so, we think the fundamentals for Japan look very good. We also think that the central bank is going to be much more supportive of the economy generally, because reaching that 2% inflation target is so important. The other thing that they have on the horizon is that they have a consumption tax, which it's essentially the equivalent of a sales tax, but they are currently expecting to increase that sales tax from 8% to 10% in April 2017. The problem with increasing a sales tax is that you get a big run-up in consumption right beforehand, because everybody front-loads their purchases to avoid the sales tax, or to avoid the higher sales tax, but then it can fall off significantly afterwards. The higher consumption tax is essentially supposed to be helping to pay down the government debt. But there's a very delicate balancing act between spurring the economy, creating inflation, and trading that off against having the higher sales tax. So we think it's highly likely you're going to see that delayed, and that you're going to see other measures coming through from the government and from the central bank to help boost the economy. So the central bank potentially can move to more negative interest rates, and they can also buy more assets. Now, just digressing slightly to talk about negative interest rates generally. So when you look at a lot of the press coverage that negative interest rates get, whether it's in Japan or in Europe, the press coverage tends to be overwhelmingly negative, because essentially if you've got negative interest rates, it's very hard for banks to pass on those negative rates to their investors, so they're essentially taking that cost. The side of the equation that gets less coverage is actually what's going on the consumer side. So if you think about rates being that low, it means that mortgage rates are also incredibly low. If you think about the amount of refinancing that's been going on here in the US in the first quarter, when rates moved unexpectedly lower, anyone like to guess what the 10-year fixed rate for a mortgage is in Japan right now? It's 0.7, well, not quite. That would be free money. That would be lovely. But it's 0.7 of 1%. So, Japanese rates have been low for some time. So typically the 10-year fixed mortgage rate was around 1.4%. But you're basically seeing people refinancing. And that frees up a lot of additional spending. So the estimates are that if only 10% of people refinance to that new lower rate, it would actually free up about 0.5% in additional consumption. So that's a big positive side of the negative rate story that you're not really hearing about. So when it comes to Europe, that's another market that we like, the Eurozone. And these are, one thing I should say actually, when we talk about markets and the way that we invest, we're investing typically in the main index. So in Japan, it's the TOPIX. In Germany, it's the DAX. In the US, it's the S&P. So while we do analysis on individual names, we're actually investing in the market as an aggregate. So when it comes to Europe, the market that we like the most is Germany. And there are a couple of reasons driving that. So with the German market, with the DAX, the main constituents of that are big multinational companies like BMW, SAP, big household names. But they're very global entities. And so when you look at what drives the underlying earnings for a lot of these companies, in many cases, up to about 50% of their earnings are actually generated overseas, outside the Eurozone. So Eurozone growth is important, and actually we do think that's going to get a little bit better this year. We think it's going to grow by about 1.7, 1.8%. But what's equally as important is global growth, and in particular growth in the US. Now, we're a little bit more optimistic than consensus on US growth. We think the US economy is going to grow by about 2.1% over the next year. But where you're really seeing that strength coming through is in the consumer. And so that really is beneficial for markets like Germany. The European Central Bank is also pursuing negative rates. The transmission mechanism, in other words, how the dynamics of how the negative rates translate to the consumer aren't as direct as they are in Japan, because the mortgage market works a little bit differently there. But overall, particularly when you see the European Central Bank, one of their most important moves is that they're starting to buy corporate bonds. And essentially what that means is that even if the banks aren't willing to lend more to individual corporates, when you have particularly larger corporates that are able to issue debt, you've got an automatic buyer in the form of the central bank. So as long as you're not a bank, the ECB essentially will buy your bonds, and that lowers their cost of financing. We also think the euro should be a lot weaker. A weaker euro, given the amount of exporting that these countries do, is very important. When you look at the underlying fundamentals, there is no question to us that the euro should be a lot weaker than where it is, and that will certainly be supportive of the European stock markets, but particularly for Germany. And I'll talk separately about currency. I'll come back to that because that is a big topic in its own right. Okay. So the market that we don't like is the UK. A big part of what drives that is the fact that there's a very big energy and mining component within the FTSE. And that really is what drags down our earnings expectations for the UK. The FTSE is very much composed of a lot of multinationals, companies like BP, where they are a very significant component of the index. That almost brings us to the discussion of Brexit, the UK referendum to exit the euro. That is going to be a very significant topic of discussion in markets over the next 2 or 3 months. So the referendum date is June 23rd. And what I would caution about is that markets are probably underpricing the risk of a vote to leave. And a large part of what drives that is, externally, you would think, looking at the decision that's being put in front of people, it would be analysed purely from a financial perspective, that of course it makes sense to be within the EU, why would you want to leave? But the discussions in the UK are much broader. And so it encompasses things like you have the European Court of Human Rights, and you have the European Convention on Human Rights. And they all sound like very good things, and in general they are. But essentially what it means is that you have had situations where the UK government has suspected certain individuals of terrorism, and they haven't been able to deport them because it would be against the Convention on Human Rights. That generates so many newspaper headlines, and it's a legitimate concern. You also have a lot of concern about immigration. So with the EU, essentially it's intended to be borderless. So the first wave, if you like, of concern about immigration was when some of the Eastern European states became part of the EU, and you had significant immigration from those states, particularly to the UK. Now, a large proportion of that immigration was very beneficial for the economy, but what tends to get the press coverage is the fact that the UK benefit system is one of the most generous in the EU. And so you are having certain individuals relocating from other countries, essentially, in order to claim benefits in the UK. Now, the numbers are pretty small, but as you can imagine, that's the kind of story that the press really like to cover. And so that has generated a lot of anti-immigration sentiment in the UK. You then add to that the current refugee crisis with the inflow from North Africa, from Syria, and you're talking about 1 million refugees that have come into the EU over the last 6 or 8 months. And the inflow of refugees is probably just going to increase over the summer as the weather improves. So immigration is a very significant issue. What's also happening when you look at the polling, and this is a challenge that I think pollsters are having pretty much across the globe. Because if you think about how polling always used to be done, they would call someone at home, ask them, well, how are you planning to vote? Typically calling on a landline. If you call on a landline, you're going to miss out a swathe of I was going to say the younger population, but actually not just the younger population, because I don't have a landline at home. So the polling gets skewed. The other thing that happens is that most of the statistical models that they will use make assumptions about voter turnout. And a general election, any elections here, if you think about the turnout levels, they're probably somewhere in or around 50%, give or take. So if you remember, in 2014, there was the referendum in Scotland about whether Scotland was going to remain part of the United Kingdom. Anyone like to guess what the turnout level was?
85.
89.
Oh, wow.
Yeah, so significantly higher. And so we would expect you're going to see a similar turnout level when it comes to this referendum. So there are a lot of variables that mean that, as in the lead up to the polls, it's entirely possible that you can have a situation very similar to what we saw in Scotland, where very close to the polling date, that the vote to leave camp actually moves ahead. And right now, just to give you a sense of what polling is, 47% are in favor of remaining, 40% are in favor of leaving. That's not a huge margin. If you're considering the sample problems, which mean that it's not really giving you a true representation. And then the other thing, just to file in the back of your mind, is that if the UK were to vote to leave, then it's entirely likely that you're going to have a second Scottish referendum, because Scotland generally tends to be much more pro-EU. So it can set in train a lot of additional elements. And if you do see a UK vote to leave, we think it's negative for UK equities, over and above what we see in terms of what's going on with the mining and the energy sector, because it's going to impose a lot more costs on UK businesses, whether it's in terms of the renegotiation of trade agreements, the uncertainty about how they will be able to conduct trade in the future. They could follow a model like Norway, which adopts most EU laws, pays into the EU budget, and has pretty free access to the EU market. Or they could take the view that actually we're going to just be governed by the WTO agreements. It's very uncertain, but both routes are likely to have additional costs for businesses. We think it's going to be bad for the pound. We think that it will weaken sterling, because you're going to see a negative impact on UK growth of a pretty significant proportion. The estimates vary quite a lot, funnily enough, depending on which side of the voting camp, whether it's someone who's saying you should remain or someone saying that you should leave. But our estimate is that, given the costs, you're going to see a drag on GDP growth of probably in the region of 1% or so, at least for the first couple of years.
What's the percent now?
UK growth? It's running at about 2.5%, 2.5%. That's what you've been seeing. So
Cut it down by half, we're looking at a third.
So you could see, that would be the worst case scenario. What's more likely is that you would see that as a cumulative impact over a few years. But yes, we think that due to the uncertainty, due to the additional costs, and what tends to happen if there's a lot of uncertainty is that businesses hold back on investing, because they don't want to spend money if they're not sure about what the environment is going to be over the coming years. So it causes a lot of things to be held back. And then the other thing to think about on the currency perspective, everyone tends to focus on the UK, but actually it's also pretty negative for the euro, and there are two big drivers of that. The UK is actually the second biggest net contributor to the EU budget. So if they stop contributing, that is a pretty big hole in the budget to make up. And then the second element is that if the UK votes to leave the EU, it provides a pathway the next time that you have a country that's in financial difficulty, whether it's Greece trying to renegotiate a bailout, as they are doing in when their next tranche is due to be paid out in June. Whilst they are also in the euro, which the UK clearly is not, it's provided a framework. And so, you know, as markets tend to do, they will push governments to see what the resolve is, and if that framework is there, it makes a potential exit much more possible. So just a few things to be aware of.
Do you think with them leaving, it could have, in the next 5 years, a domino effect, in theory? Because there have been people who have speculated that the euro could fall apart, and not necessarily the currency, but it slowly lose countries. And if UK, for them being one of the stronger countries to leave, do you think that more would follow its footsteps?
Well, I think what is I think it makes it a more viable option. It's probably still not a very desirable option for any of the countries. But if you take the case of Greece, for example, where, you know, GDP growth has contracted by almost a third since the bailout program began, where they're carrying a debt level that is very much unsustainable. The currency hasn't devalued in the way that if they still had the drachma, it would have. And so when you're looking at economies that are in such a dire state, it's bound to be an element of discussion. So yes, at the margin, I would say it does make it more likely. So just a couple of other things to touch on. You know, we think on Europe generally, looking at the refugee crisis, long term, that could be a very big positive for Europe, because it could help to solve their demographic problem, because most of the migrants are younger, and Europe has an aging population. But in order for it to work effectively, they need to spend an awful lot more money integrating, both providing services and essentially integrating the newer population. There was the current spending, in our view, is significantly less than it needs to be, and in order to really make it effective, there was a letter that George Soros wrote, an open letter to the EU. He published it maybe a couple of weeks ago. It's pretty interesting reading, but he's citing, you know, the amount of spending that needs to take place, which is not just the support for the migrants, but also spending to support the local population, so that they don't feel disadvantaged by the money that's being spent. But the numbers that he's citing are, you know, 50, 80 billion. It's a lot of money, but, you know, the biggest problem that Europe has is the fiscal conservatism that Germany has, that they always want to reduce spending rather than spend to create growth. It's something that any of the countries that were in a bailout program really did struggle with, and this would be completely counter to what Germany has essentially been advocating for the last several decades. So something to keep an eye on. It's not going to be, you know, tomorrow's problem, but longer term, it will have a pretty significant impact on the health of the European economies.
What did you say Germany's growth rate is?
Well, Germany is growing at about 2% a year. You know, that's one of the other things that is interesting. So in a year when Germany is growing really strongly, they're probably growing at maybe 2.5–3%. None apart from the very small European countries really ever tend to get to some of the higher growth rates that the US economy has had, and it's in part due to some of the additional labour market inflexibility, some of the structural issues within those economies. So when we talk about Europe growing very strongly, we're probably talking about a 3% growth rate. So just circling back, and I know we're almost out of time, and it's been great that everyone's been asking questions as we've gone through. So, and I'm also glad we kept you in the room. So, but the dollar. So, you know, we saw very significant dollar strength in late 2014, early 2015. And there were a lot of factors driving that. So we were certainly seeing the US economy picking up pace, picking up speed. You were seeing a stronger labor market. You were seeing a lot of expectations that you were going to see the Fed hike rates. We're still in favor of the dollar. We still think the dollar is going to strengthen further from here. It's not going to be at the pace that you saw in late 2014, early 2015, which is actually more beneficial to the economy because the pace of strength you were seeing at that point is just so difficult for corporations to deal with, and it's very difficult to get hedging policies in place. But the reason that we think the dollar is going to strengthen from here is that the US economy is still growing at a much faster rate than most other developed markets. The central bank, albeit that the Fed has been more dovish over the first quarter, which we think is right, is still farther advanced in a tightening phase than any other central bank globally, pretty much. Where you look at Japan and Europe, they're still loosening policy. We think that inflation is probably going to remain reasonably subdued, but what we're focusing on really in terms of the strength of the economy is the consumer, and so that is. That we think is really the key. But our expectation for US growth over the next year is 2.1%. And we think that some elements of what has been supporting the consumer are going to naturally unwind. For example, we've been starting to see energy prices moving back up. But one of the big questions last year was, well, where is that money going? Why are we not seeing consumer spending moving up more because of what they're saving at the gas station? Well, from what we can see, the evidence is that they were paying down debt, which to us, and I think one of the other speakers mentioned that today, to us that's actually a big positive longer term for the consumer.
With Mexico, in terms of their growth and their currency, their strength.
So the Mexican economy is obviously very interlinked with the U.S. economy, and the fact that the U.S. is performing better is beneficial for them. But what we've also tended to see is that when the U.S. Is raising rates, generally across the board, it tends to be negative for emerging market currencies. So Mexico isn't a huge area of investment for us. Emerging markets generally we're not allocating a huge amount of risk to right now because we think there are, particularly for some of the larger economies, some bigger structural issues and big macro challenges that they're facing. So for Mexico, we think it should perform reasonably well because of the links to the US, but we wouldn't see anything startling coming through from the economy in the short term.
I have two questions. When you're talking about the dollar strengthening, when companies, that are so multinational are announcing their earnings, they often say the dollar's been hurting us, overseas. And so I guess my question is, if you continue to see it strengthen, how that might affect the, U.S. market in terms of all these big companies. But the second one is, you've been talking about these other developed markets. It sounds very volatile. Is that an opportunity, or is it, a lot of times you hear just the safest thing is to stay in the U.S. markets?
Okay, so your first question about U.S. companies. So the reason that you hear the U.S. companies complaining is because, let's say, they're selling, a can of Coke. And that's, let's say it's selling at €1. If you look at what the euro was worth, let's say 2 years ago, that was probably getting them $1.50. Today, it's getting them $1.10, but they can't change the price of a can of Coke to reflect that. So basically, that's the problem. Now, it's not that the dynamics have changed in the underlying economies, it's the fact that they haven't been able to hedge that, particularly and in fact, when you looked at the end of 2014, early 2015, those were exactly the kind of moves that you were seeing. they are in much better placed to have hedging programs in place now, so that it means that they can be at least somewhat protected against further dollar strength. What you often see big multinationals doing is, a lot of them have production facilities overseas, so they are matching their, if you like, their costs and their inflows and where their profits are being generated. But the problem is when those profits get translated back. And so the biggest challenge, we think, is that companies need to have a hedging policy in place. And if it's not something that they had in place, and those companies that were announcing the very big impacts were typically at the lower end of the hedging policy spectrum. So so the fact that it's now a more consistent trend gives them more of an opportunity to have those policies in place. It's not going to completely go away, but the effect should be significantly mitigated, at least for those companies that are proactive. The second question about risk. So it's a very interesting one. I think that wherever you look at investing, there are risks. So whether it's earnings expectations moving lower in the US, the potential impact of the presidential election, it's hard to think of anywhere you could invest where there isn't some risk. But I think what tends to happen is that domestically it's a lot more familiar, and so it doesn't seem as risky as, say, I don't know, Greece trying to renegotiate another bailout amount. But actually what you really need to think about is the diversification. And so, of course, invest in the US. We're not saying that you shouldn't. But the opportunities that international investing give you are to really have other elements in your portfolio that perhaps can perform well when the US isn't performing quite so well. And yes, the risks are different, but the drivers are also different. And so it means that you've got a broader portfolio, which should, in aggregate, deliver an attractive return. So, let's say, for example, and this is, I'm making it up now, but, let's say Trump wins the election. Well, he gets the nomination and then he wins the election. That could have a negative impact on US assets, but it should have very little impact on, say, European or Asian assets. And so, that's one of the ways in which you might see international diversification helping you. And the way that we look at the world is, look, there's a lot of opportunity out there. And we want to have as broad a set of opportunities that we can potentially invest in as possible. And so for us, we think that, expanding our horizons outside the US makes a lot of sense.
Thank you.
So if the UK decided to stay in, can we assume that that's going to be a positive impact on the pound?
So it, of course, depends on everything else that's going on at the same time. But generally, yes. I mean, if you look at
depressed now because people are unsure.
Yes, that's exactly it. I mean, you have seen some slightly weaker economic numbers, but nothing that would have prompted the kind of currency weakness that we've been seeing. And the pound versus the dollar, long term, it tends to trade in a range of 140 to 160, 165. If it's above the upper end of that range, it's really, really strong. If it's at the lower end or below the lower end, it's pretty weak. Now we've seen a bit of a bounce over the last couple of days, so now it's about 145, but most of the last month it's been closer to 141, 142. So yes, we think that would be a significant boost to sterling, getting rid of that uncertainty.
Thank you so much for...
Well, thank you, everyone.
Thank you.